All right, all right. Welcome back to the All In podcast here in Franklin, Tennessee. And as you can see, we got a little bit different format today, and that is because I have a very special guest who is out of state and who I have with me today. I'm going to introduce to you, but I want to tell you a little bit about him. So Sean Lane is the author of The Consumer's Guide to Credit Restoration. He's also the co-founder and CEO of Financial Renovation Solutions. So it's frscredit.com. And he's been educating consumers about credit since 1992, and he's done so on a full-time basis since 2013. So he talks a lot about teaching consumers how to understand credit report, credit scoring systems, including the best way to maximize your credit score and avoid your credit score setbacks. So obviously, when we're in the mortgage industry and real estate, we're always trying to get people to the finish line and to get them to a better place. So Sean has extensive experience in detecting credit reporting errors. And just the time I've spent with him, I mean, I've already learned things that we're going to actually be able to help people close deals. So he's got a specialized knowledge regarding just how serious credit reporting errors can be and the significant consequences and damages which can occur when these errors do occur, and how they can really wreak havoc on a person's life. So as a credit expert, Sean routinely speaks at educational seminars to professionals in the mortgages, banking industry, and real estate industries. And he's also a credit expert witness and legal consultant in credit reporting and credit damage lawsuits. So you can see him at Sean Lane, SHAWN Lane, LANE.com. And his true passion, as you've gathered, is helping clients escape the bondage of low credit score and what enables them to achieve their credit goals, like home ownership. So Sean, welcome. You're all the way from Austin, or no, you are in DFW area, right?
Yep, McKinney, Texas. Thank you.
Texas. All right.
Yes, sir. And I appreciate you having me on today. I love this topic. I love talking about it. And, I like to call your credit score, it's your adult GPA. It's your grade point average,
Right.
So many things we do have a credit score component, including buying a house.
Yeah. Well, I want to jump right in, man, because we've got people that are out there that I know that you're going to be able to help. And so let's just jump in. I mean, obviously we're in this industry, and like we were saying before we hopped on, I've been doing this 2.5 decades, and, you feel like as an experienced loan officer, mortgage professional, that you have a decent grasp. You look at credit reports and some tricks that the average person doesn't know. But then when you really get to someone like you, then I quickly realized, man, I need someone like you. We need someone like a Sean Lane in our corner, because I mean, just what I've already learned from you, and just little nuggets, when you talk to somebody and you find these little nuggets and you realize, well, if this is just falling out of his pocket, just imagine what would happen if you're walking together all the time with it. So I really appreciate you being here. So I want to jump into some questions. So, one of the things that people, want to know a lot of times is, how does a hard pull affect their credit score, like when they're mortgage shopping? So talk about that a little bit, what that looks like, because, I think people have different ideas and there's all kinds of stuff floating around out there. So talk about that a little bit.
Yeah, absolutely. So, typically whenever you apply for credit, that results in a hard inquiry on your credit report. And most of the time, every inquiry hurts you a little bit. People always ask, well, how much? Is it 5 points? Is it 10 points? And to be honest, it's dependent upon that individual's credit report, right? Because credit report's like a fingerprint. Everybody has a different one. Some people have more accounts than others. Some people have, longer credit history and so forth. And so, those inquiries do hurt you, but there is some special logic built into the FICO scoring algorithm that accounts for mortgage inquiries. Okay. And I'll just quickly explain what that is. So if I applied for a credit card today, immediately that hard inquiry impacts me a little bit. But if I apply for a mortgage today, there is a delay of 30 days before that mortgage inquiry has any impact to my credit score. And so by design, that is to allow somebody to rate shop. If I'm looking for credit cards, uh, and I'm applying for 2 or 3 credit cards in a short period of time, that's a red flag. If I'm applying for a couple of different mortgages, I'm most likely rate shopping or trying to figure out which lender I'm going to use. And so FICO has built some logic in, and there's actually 2 pieces to this. The first piece is the 30-day delay. And that 30-day delay basically allows you to go out and maybe talk to a couple of lenders, and that hard inquiry when you apply will not hurt your credit score for 30 days. But there's a second piece to this component, and this is the deduping period. So there's also logic built in that any mortgage inquiry within a fixed time frame consolidates and only counts as one. Okay, so and it gets a little bit tricky, and we get into the weeds here, but on TransUnion and Equifax, there is a 45-day deduping period. So, once that 30 days pass, now that inquiry is going to impact your credit. But all mortgage inquiries within a 45-day period are only going to count as one. You're going to see all of them on your credit report, but as far as credit scoring goes, it's only going to count as one. However, on Experian, they have a 14-day deduping period. So it's compressed from 45 days down to 14 days. So what I coach people in is if you're gonna go to a couple of different mortgage lenders, get your applications done within 2 weeks, and then those are only gonna hurt you, as one inquiry.
Yeah. So why are credit scores different? You've got FICO scores, Vantage scores, you've got these scores, and obviously with us, a lot of people will say, hey, Credit Karma. So talk about those. Like, I know what I say, but you tell us the gospel. Like, what is the difference there?
Okay. So, credit scores are, I guess, first of all, the credit bureaus are for-profit companies, right? And we have really the main 3 that everybody knows about: Experian, Equifax, and TransUnion. And those companies make money by doing a number of things. Obviously, they make money when I apply for credit with a lender. That lender is paying to pull my credit report, so they're paying the credit bureaus. Okay, when if I'm a consumer and I'm disputing something on my credit report, the credit bureaus actually have to pay 30 cents per dispute to process that dispute, right? Let me just back up. That creditor. So let's say I'm disputing something with Bank of America. Bank of America has to pay 30 cents for that dispute. If I have an account with Bank of America and Bank of America is reporting that account on my credit report, they're paying to report that account on my credit report. And then lastly, credit bureaus sell consumer data. So they make money by credit applications. They make money by reporting stuff on the credit report. They make money by selling our data. But the one area that they haven't made money in is in credit scoring, because FICO has owned that world. Okay, and FICO is a completely separate company. And so FICO, or there's been other credit scoring companies or credit scoring brands that have gone, into the market over the years. And the one that has really gained traction is Vantage Score. Vantage Credit Score Solutions is most known because of Credit Karma. But what a lot of people don't realize is Vantage is a partnership between the 3 credit bureaus. So, the credit bureaus wanted to get into the game of selling credit scores so they can make money in that arena as well. And so that's why we have the Vantage credit score. So there is a ton of credit score confusion out there. And people ask me, what is my real score? You probably have that question, right?
Yeah.
Also, well,
Sure.
when it comes to mortgage lending, your real score is your mortgage FICO score. But, there are actually 28, maybe more than 28 different versions of FICO. So, there is the version that you get for free right now from Experian, which is a FICO version 8. But there's also the older classic versions, and then there's industry specific versions. And the mortgage credit scoring model is a 20-plus-year-old model. And so I kind of liken it to, to our cell phone. We have a cell phone. Every now and then they roll out a new operating system or a new iOS, and we can, as an individual, we can take the new software download, or we can keep the old software version. And then if our equipment is too old, we can't upgrade to the latest operating system for our cell phone. Kind of the same thing in the lending world. These lenders can use any model they want. And FICO every few years rolls out a new scoring model that they have tested, and they can depict risk better of a borrower. Maybe they've come up with some new algorithms, or something. And the lender can choose to use the new version, or they can keep using the version that they've always used. And so a lot of times it requires an upgrade of their systems and so forth. And so when it comes to mortgage lending, mortgage has been using this early version of FICO for 20-plus years. There are some conversations out there about they're testing new models, but as we both know, real estate and mortgage is so highly regulated with the GSAs and all of that they can't just make a change. So across the board, mortgage is using an early version of FICO.
So given the differences between, FICO and Vantage, you've got Credit Karma, freecreditreport.com, all these different, models and whatnot. What do you have a recommendation for customers, consumers out there to keep a good watch on their credit?
So even though we've got all this confusion out there, right, with credit scores, even to the point, if I applied for a mortgage today and then tomorrow I applied for an auto loan, that score is going to be different because the auto lender is using an auto version of credit scoring. So they're all going to be a little different. And then, of course, if I'm using Credit Karma or some other credit monitoring service, I'm probably getting a Vantage credit score. The good news is all of the credit scores pretty much use the 5 main ingredients that impact your credit, and if you want, we can kind of go through those and kind of talk about that. And so there's really 5 main things that impact our credit score. And this is one of the things that I think is valuable for individuals to know. And those are payment history, which is worth 35%. And then the debt category of our credit report. And this is heavily influenced by revolving debt. And so that is worth 30% of our credit score. 15% of our credit score is based on the age of our credit file. And then 10% is the mix or the variety of accounts that we have on our credit report. And then the final 10% is those new hard inquiries. So Vantage is a little bit different. They still use the same 5 ingredients, but they put more weight on revolving credit than FICO does. But generally speaking, if we know those 5 things, then we've got the knowledge to improve and better our credit report and our credit score across all models. And so if your question is how should somebody look at their credit report, I will tell you that my favorite credit monitoring is MyFICO. So, MyFICO, gives you all of the FICO versions that are used in lending. But MyFICO
literally just myfico.com for our listeners.
MyFICO. Okay. Yeah. And, but, it's expensive. I think it's a $40 or $50 monthly service. And so we send our clients to a company called ID Club. And they can get that on our website. And one of the benefits of ID Club is that if they use the link on our website, it offers a $1 7-day trial. So this allows somebody to look at their credit report just to see what's going on. And then to maintain that service, it's $19.95 a month.
Okay.
What's most important is that people review their credit report. In today's world with identity theft and data breaches and, medical issues with, insurance and who's responsible for paying, It's super important that we monitor our credit and know what's going on with it, because just because I had good credit 2 years ago doesn't mean I still have good credit. So
Right.
we gotta look at it.
Yeah. And guys, listeners out there and viewers here on YouTube, be sure to like and subscribe. And any questions you have, dump them down here and we'll make sure that we get those answered for you. So, what are your top three, 2 or 3 tips that, I mean, a lot of us know keep your balances down. There's a certain percentage that you should keep your balance on a revolving account. But like you said, the debt category, that was what you're talking about. That's going to be a car payment or or versus a revolving account. So it's going to be a loan versus a revolving account. That's the category we're talking about there, right? And so it is true that these I've always heard that it's really the revolving, it's just really that utilization. So if people drift up and they got $1,000 limit and they owe 900 or God forbid 1,100, like they allowed them to go over, that's where the scores start to dip, right, Sean?
Absolutely. And so that category, that debt category, is heavily influenced by revolving debt or credit cards. Yes, other types of debt are calculated into that category, but the reality is I can have millions of dollars of auto loan debt and mortgage and student loan debt on my credit report and still have a very, very high credit score. But if I have, you know, hundreds of thousands of dollars worth of revolving credit, I'm going to have a lower score. And so that category is heavily influenced by revolving credit. And what I've found by looking at thousands of credit reports is that the best place to be with your revolving credit is below 10% utilization.
Okay.
A lot of people throw around the number of 30%. And yeah, 30% is a great goal,
It's
but
better than 50,
20%,
better than
that's
60, but
right.
right.
Yeah. But 10% is really, really
Ideal.
the sweet spot is between 1 and 6%, but
Right.
it's a
So
lot
other
easier
than
just to say
those,
10 pro.
what are your top, what do you say, for our listeners out there? Let's get into the nitty gritty. Like, I get a lot of people approach me, in my DMs, questions on YouTube, questions on Instagram, Facebook, hey, I've done this. I don't know what to do. What would I do? Like, how do I get my scores up? And, what are the top tips you think to help raise a score? We talked a little bit about, obviously getting your balances down, but some of these people have already maybe paid a collection and they didn't negotiate a deletion letter. We can talk about that, but like, what are some things that people could do to help, raise their credit score and build solid credit?
Yeah. So, and I teach a class called 7 Steps to a 750 plus credit score. But my number one thing is looking at your credit. Okay. So you got to have credit monitoring. And a lot of us get a credit score from our credit card, but we need to understand that that's just one bureau, right? And so we need to be looking at all three. So, we need to look at our credit report. Second thing we need to do is we need to dispute those derogatories. Whether you do that on your own or hire a company like ours. The Fair Credit Reporting Act says that what's on your credit report must be accurate. It must be verifiable by the furnisher, the company that provided that. It can't be misleading. It must be complete, so it can't have missing data, and it has to be timely. So, definitely challenge those derogatories. I would say the third thing is understanding how the credit scores are calculated. And, we kind of just quickly went through that. That 35% payment history, that's the biggest, impact to your credit. So obviously, got to pay those accounts on time, never be 30 days late. Mix of credit is very important. What I've found is that a good mix of credit is at least 3 credit cards and
I
at
love.
least one installment loan. A lot of people out there who've had their credit, they've made some mistakes or they had some life events happen to them. They've kind of checked out of credit. And so they end up having what you'd consider a thin credit
Yep.
file, like
Yep.
not very many accounts. And the problem with that is a derogatory event is going to just nail them so much harder than somebody that has a lot of account variety.
Right.
So I would say that, you definitely want at least 3 credit cards, at least 1 installment loan, but a minimum of 5 open accounts on your credit report.
And I think that's huge, because I think you're right. So what I see a lot of are clients that, just like you said, they, they had student loans that they maybe even paid late, they defaulted on, maybe they had a divorce, they did a collection. Now they're in a place in life where they're like, how bad did I shoot myself in the foot? I want to do better now, but they don't know what to do. And so what I hear you saying is, number one, you know, make sure you have 3 credit, because some people just like say, well, no, I'm not going to do with credit cards anymore.
Right.
They don't know what, and they don't know how to utilize them. So get some credit cards, get 3 at least, have maybe an installment loan, but then keep those balances at 10% or less. But then here's where we're going to get into it. This is what people want to know, brother. They've messed up and they've paid this collection and they didn't know what a deletion letter is. So talk about that, because I learned something today, from you just talking about that they can still dispute the paid collection, even though, that's, and I always liked it to, this is what I always say to people. Hey, when you pay, if you get a speeding ticket, we know behaviorally in America, you should try to go to court and maybe you get to go to the driving school, because if you just mail in the payment, maybe you're on the way to vacation, you're out of state, and maybe that's the only, but it's a problem because once you pay it, you've admitted to fault basically, and now it's just on your record. You can't get it off. But a deletion letter states that the creditor is going to remove it from all 3 bureaus. And what we teach people obviously is, don't pay a collection until you have negotiated the deletion letter from them in writing. So don't take their word for it over the phone that they're going to delete it. You get it they're going to delete it from the agencies that they've pulled from, or that they report to. But then unfortunately, you've got a group of people out there that they've messed themselves up with credit in the past, like student loans, and then maybe they've even paid a collection. So talk about that. Like, what do you tell people like that? Because they're not stuck. They've got solutions.
Yeah, and they've actually done, and they've gone back and done what they thought was morally right. Right?
Right.
They took care of that debt,
Mm-hmm.
and then they find out that that hurt their credit score.
Yeah, I didn't
And
say
so,
that. So explain that, like, because paying the collection actually doesn't help intellectually,
yeah,
people think, I pay this collection, well, that's going to help my score. Talk
yeah,
about that. It doesn't work that way, does it? It actually hurts, or it doesn't help.
yeah. Let's take this a step further. So, you've got charge-offs, and
Yep.
then you have collections,
Right.
and sometimes people get those confused. So a charge-off is, I had a Capital One credit card. I went into default. Capital One ultimately charged that off as bad debt. Okay. Um, Paying that charge-off to the original bank will almost never hurt your score, and in most cases will help your score. Okay.
That
But
is great
once it,
info, guys. Are you listening to that? So the charge off, you let the card go. Yeah, they charged it off, but but Bank of America or Capital One still has the account. But and now what Sean is saying is, you want to go ahead and you can pay that, and at that point that can be helpful. So to continue on, but if not,
yeah,
then what happens? It goes to a collector sometimes.
yeah, and some of these banks uh, don't send these debts to a collection agency that credit reports it, so they hang on to it. So a good example is like a Wells Fargo. Okay, if you see a Wells Fargo, it's never going to be with the collection agency. It's going to be a charge off from Wells Fargo, and so the difference is that once it goes to a third party debt collector and it's reported by that debt collector, um, there there is a flaw. We talked about credit scoring models. We talked about how mortgage uses the very old versions of credit scoring that are 20 plus years old. The flaw in mortgage credit scoring is that when you pay a debt collector that's on your credit report, when they report that account as paid, it looks to the scoring model like it's new activity, and it will drop your credit score in most cases. Recency in credit scoring matters. How recent the derogatory or negative event happened. So you can literally take a 3-year-old collection account that's not having as much impact to your credit score. And if you pay that today, that in most cases will drop your mortgage score. Now, a lot of the newer versions of credit scoring, including Credit Karma, will reward you in points when you pay a debt collector. Okay. But that is not the model that you want to be concerned about. In our business, most of our clients are trying to buy a house and they're referred by companies like yours, Mark. And so we educate based on mortgage FICO scores.
Yeah,
And
because the
so,
Credit Karma score doesn't really help them. It doesn't get them. It's just really a monitoring system. And so that's very interesting. So they go pay it, and they get their new Credit Karma, and they see, wow, I went over 700 now. Then they go to apply for the mortgage and they get pre-approved, and we tell them it's still 640. And it's
yeah,
because, they don't really, it doesn't work that the same across the board.
exactly. And, a lot of people call it the FICO score and the FACO score, right? Well,
That's right.
the reality is
FICO
that
is where it's at, is the bottom line.
FICO, 90+% of lenders use a FICO score. There are, Vantage score is gaining traction. As we talked, there's discussions about introducing that into the mortgage world here in a year or so. But today, it's FICO that matters. And so, yeah, if you're going to pay a debt collector, you definitely need to get that deletion letter from them, because you can take that deletion letter and you can send that to the credit bureaus if they don't follow through with the deletion, or to even speed up the deletion. Take that deletion letter, send it to the credit bureaus and say, this needs to be deleted because, the debt collectors said they were going to delete it.
You go ahead.
Yeah. And now when it comes to, let's say you've already made that payment, right? You didn't know, you did you did the right thing. You paid that debt collector. You still want to dispute that account on your credit report, because you're disputing it to make sure that it's accurate and it's verifiable with the furnisher. Okay. And you never want to dispute online. Okay. These credit monitoring companies like Credit Karma make it very easy to open a dispute. But the problem is there's a provision in the Fair Credit Reporting Act that says if you dispute online, they do not have to notify you if they decide to reinsert the item. And that happens a lot. However, if you send a letter to the credit bureaus via snail mail, the old school way, the credit bureaus must give you 5 days written notice if they plan to reinsert an item on your credit report. And it almost never happens. I've seen it once in all my years of doing this. I actually saw the credit bureau response that said, we are reinserting this item.
Why can they reinsert?
It's a provision in the Fair Credit Reporting Act that, let's say that the creditor didn't respond in a timely fashion, so the credit bureau took it upon themselves to delete that account or correct it in favor of the consumer the way they wanted it. And now later they receive some, verification information. They can reinsert it, but they have to give you notice, and they don't do it.
They
just
don't do it. Okay.
Mm-hmm.
So yeah, that makes a lot of sense. So someone has, low scores, late payments or collections. You recommend going ahead, disputing those, even though if you paid them, and you did dispute them. So how do they go about that? Like somebody's sitting there, somebody's listening right now. They want to know, where do I go? I don't go do I go online? How do they dispute that? Because you're saying you need to do it in writing. So do they literally Google, Equifax, TransUnion, Experian, and mail them? Is that what they do?
Yeah, and it's best to send those certified mail so that you can track it. You can, off Google, you can get the credit bureau's address. Many of them have 8 or 9 different addresses. You can use any address for the credit bureau to send your dispute letter to.
And so they don't need to be an ID club or have micahfico.com to initiate that. You're going straight to the top at this point.
Yeah, they just have to have some means of knowing that item's there, because and that's one of the problems with Credit Karma. Credit Karma doesn't give you any account numbers. So you really can't dispute an account using Credit Karma, because you don't know what the account number is to place in your dispute letter related to that Chase
Mhm.
credit card or that Bank of America credit card. Not to mention, Credit Karma is really a marketing company that tries to get you to apply for credit because that's how they
Right.
make money. So I don't like Credit Karma, but when it comes to disputing, you need to pull your credit report somehow, right? ID
Yeah.
Club, you can go directly to the credit bureaus. And by the way, the place that you can get a free credit report from the credit bureaus is annualcreditreport.com. So
Okay.
annualcreditreport.com is the government sponsored site that they have to give you a free credit report directly from the credit bureau once a year. But once COVID happened, they do it weekly right now, and they've decided to extend the weekly service until the end of this year. It's not easy. I mean, when you go get your credit report from annualcreditreport.com, you actually have to fill it out individually for each credit bureau. And then they're going to display that credit report on your screen, and you have to save it as a PDF. You can't log back in. It's just like, here's your report. You either print it, save it. There's no credit score. There's no monitoring. And it's going to be a cumbersome report to look at. It's most likely going to be 100 pages or more,
Yeah.
from each bureau. The reason we like a credit monitoring company is because it shows us each credit bureau side by side. So Capital One, and it shows us how Experian, Equifax, and TransUnion report it. That is how I find discrepancies,
Yeah.
right? Because our credit report must be accurate. And so I use their information back against them when I dispute an account on a credit report.
Yeah. So I want to tell two more nuggets. One I'm going to share that you shared with me, and then I want you to think of one that's maybe people just don't know. Like, I bet you didn't know this one. And then I'm going to tell people how to get in touch with you so that you can help them. But one thing that you told me today, or yesterday, was, and I kind of knew a little bit about this, that you can use, to be added to an authorized user. But I had a client that needed 10 points.
Mm-hmm.
And so I send you over a copy of the report, and the client that needs the 10 points has a spouse, and that spouse has two accounts that have zero balances, two credit cards, one with like a rooms to go and another one with like a care credit, something like that. And they have zero balances, and they've been paid on time. And so you recommended to add the spouse that needed the 10 points to those two accounts to help boost the scores, because it's got a long history. The age was there, the utilization, the debt category. And so all of that is helpful to help raise the score. So these are the types of things, guys, that knowing these types of things is really going to help you to do what you need to do to get yourself in position to buy the next home. And if you're kind of nervous, you don't know, am I doing the right thing? You can always reach out to me or to Sean. But like, Sean, what's another good one? And then tell people how they can work with you, and maybe give them an idea of what it looks like to do so.
Okay. Yeah. So one of the things that is confusing out there is, when should I pay my credit card to maximize my credit score? Okay. Because the reality is, if you pay your credit card in full every month, on the due date, you are not. What am I trying to say? When you make a payment on your credit card, it doesn't update at the credit bureaus right away.
Right.
Okay. The credit bureau, the Capital One credit card or whatever, only reports to the credit bureau once a month, and they report the snapshot of your account that comes out when your statement is generated. Okay. Your bill is due what, 21, 25 days later. So if you don't have high enough credit limits and you use your credit cards and pay them in full every month, they're catching you with a high utilization. So if you have low credit limits, maybe you're in the spot where you're rebuilding, pay your credit card before the closing date. Okay, before the statement closing date, get that payment in right before the closing date, because that's going to then report at the credit bureaus the lower balance.
What a great tip.
If you wait and pay it when it's due, you've already racked up new charges on that card, and
Mhm.
so it's gonna show a higher balance.
So just to repeat that, you want to pay that credit card before the actual due date. Is that correct? Am I saying
No,
it
you want to
correctly?
pay it
No,
before the statement is
before
generated.
before the statement is generated. And so, how
Yeah.
do they know when the statement is generated? Explain that.
Yeah, so we'll use Capital One as an example. Most of these have an app. You just go on your app and you look at the statement dates. Right. And
There you go.
maybe the statement, closes on the 27th of each month. And so, now this is really for those people that don't have a lot of credit limit, right? And so
Mhm.
they've got small credit limit credit cards. You just want to keep those balances low. And the other thing I'll tell you is you definitely want to have a small balance on a credit card. You will score higher by having a small balance
As
than if
opposed
you
to
had
zero.
zero balance. Yes.
That's a great tip. And I think I've got one from the studio from our producer here. Question: what if the due date is the 16th, but the statement is generated on the 19th?
Then pay more, right? Because let's say that your bill, the statement says you owe 1,900, but your actual balance on that card is 4,800. They just haven't generated the new statement,
Yep.
right? Just pay more to get it to reflect that lower
I love it.
balance. Now, obviously, if you've got, the power of credit cards is that we can use the bank's money and we can get, rewards and stuff, right? So if you've got good credit cards, multiple credit cards, high credit limits, you don't need to worry about this. This is for the person trying to rebuild and they've got those small credit limit credit cards. You want to just, pay those before the statement
And this
closing
is a
date.
lot of our audience right now. I know there's a lot of listeners out there. I have a big following on Instagram and TikTok, and we're getting a lot of questions. This is so valuable, brother. I can't tell you how much I appreciate you being on. Um, tell our listeners, our viewers, how do they work with you? Because I mean, we're talking about the best of the best. I sought out the best in the country. You asked, I listened, and here we are. Okay, so I'm here to serve my following, my flock. And, this is so Sean Lane here is who you need to be talking to with FRS. So talk about how they can work with you.
Yeah. So best way is to go to our website, frscredit.com.
Easy
So
enough. FRScredit.com.
yeah, and if you can't remember that, Financial Renovation Solutions, it's the
Yep.
acronym. So frscredit.com. On there they can book a free consultation with myself or one of my credit consultants. I have, including myself, we have 6 credit specialists that do what I do. And what we always do
Also
is,
bilingual.
yeah, we
Also,
have
you
a
have a
bilingual.
bilingual person.
Yep.
Okay. Yep.
Yep. And here's the reality. We don't enroll people in credit repair without looking at a credit report because it's not always the right time to do credit repair. Maybe somebody's in the midst of defaulting on accounts. Maybe they're 30 days late on this, 60 days late on that. They have a financial problem. Maybe right now is not the time to do credit repair for them, right? And so we want to review the credit report first. We're going to do a full credit analysis for them for free because we want to make sure that they're a good candidate. And if, today, and if they're not a good candidate, we're going to give them some tips and then ask them to call us back in a few months. Okay.
Yeah.
I'm not talking about the guy that has things that have happened in the past. I'm talking about the guy that has current late payments. He's behind on some things. That's the guy that we're not going to enroll today because as long as he can't pay on time, I can't move his credit score. If
Right.
that makes sense. Okay.
Sure.
And it's very easy. What we're going to do is, and it's on our website, we're going to send them to ID Club, but use the link on our website because it's a $1 7-day trial. So essentially it costs them $1 to have us review their credit report.
Right.
And, we'll do a full credit analysis for them. We'll offer them our program, and our program is a maximum of 6 months long. We work on all the derogatory stuff at the same time. Some of these credit repair companies stretch it out and,
Yep.
they try to keep you enrolled. And so our program is a maximum of 6 months long. They're not even required to stay in 6 months. What causes credit repair to take time is every time we dispute or send an investigation letter, they have 30 days to investigate and respond. We do that process 6 times if necessary. We have a 6-step strategy that we walk through to try to legally leverage a bad thing off of a credit report.
Now, I want one more quick question. Okay. So, some people say, I've had several comments, particularly in the TikTok realm, where they'll just say, yeah, just don't pay it. It'll fall off eventually,
Yeah, well,
when it comes to a collection or something
yeah.
like that. So what do you say to that?
Well, so here's the thing that I always say. 2 things can fix everybody's credit: time and then education, right?
Okay.
If you let enough time pass, you're right. Those
And tell them how
derogatory,
much time. Tell them,
yeah,
Sean.
those, yeah. So a derogatory account is based on what they call the date of first derogatory that led to default. Okay. So what that means is if I paid something 30 days late today, that 30-day late payment will fall off of my credit report in 7 years. Okay. If this account got charged off as bad debt, so if I was 30 days late, then 60, 90, then it got charged off, 7 years from that 30-day late payment that led to default, that account will naturally fall off of my credit report. Every month that passes that an item is, that derogatory event, that every month that passes from when that derogatory event happened, that derogatory thing, whether it's a late payment or what have you, has a little less impact to your credit score, but it's going to be on there for 7 years. Okay. So yes, the 2 things, time and education. You let enough time pass, those bad things are going to be a distant memory. But the problem I find is that a lot of people lack the education. That's why we're so big on education, because I find that people make similar mistakes over and over, and it keeps them in perpetual low credit. And we want to
Yeah.
change that.
Yeah. Yeah. And 7 years is a long time for any of us, for just about anything in life. And so if you can get something off of your credit, you want to utilize Sean, utilize me, you know, people out there, Sean, they want to buy homes. They're young. We've got millennials, we've got Gen Z, and they're discouraged. Some of them, right? Housing is expensive now. And so then maybe they made a mistake in their past. They're a different person now, and they beat themselves up. And my heart goes out to them, because this is what I do on a day-to-day basis, and I love it. But it's a weight. I mean, and I know you feel it, because you want to help people. And sometimes, you know, it's undoing some things that they did, that were, maybe they paid something they shouldn't have, and they just didn't know any better, or they're when you meet them, they just kind of swept it under the rug and thought it would go away, and it's been 4 years, but heck, you got 3 more left, and now you're wanting to purchase. So there are options you can do. Like we said earlier in the show, you can still dispute those accounts, guys. So frscredit.com. Sean Lane is the guru. Sean, also, you want to pick up the book, The Consumer's Guide to Credit Restoration. And Sean, we really appreciate you, man. Thanks for being on today. And we're gonna load you up with some clients and start helping some people become homeowners.
Well, I appreciate it, Mark. And again, I love this topic, and I think that everybody deserves a second chance.
No doubt.
Sometimes it's just lack of education. Maybe they were young and dumb like I was. That's why I have this business, is because I was that person, that made all the classic mistakes when I was younger.
Well, and you talk about the lack of education. It's another way we talk about on this show is just, the All In podcast. We talk about being all in all areas of your life. And one of them is just being all in right on your credit monitoring and knowing what's going on there. But heck, a lot of times people just don't know, they have no
Yeah.
idea what it is. And so
They don't teach it in school.
so education, another way to say that is new information. So many times people just don't know what to do because they don't have the information. They just don't know. And then when they try to go find it on the interwebs, they get 100 different answers. And so, guys, that's why I wanted to bring Sean on. Sean, we want to be honoring of your time. Thank you so much. And we will talk with you soon. Appreciate you, brother.
All right. You guys have a great weekend. Thank
Thanks.
you.
You too. See
All
ya.
right. Bye bye.
Bye.